Hey, y'all.
And joining us now, a partner at Element Wealth, Jeremy Nelson. Jeremy, thanks for coming in.
Thanks for having me. I'm a big fan and was listening the whole way down from Philadelphia this morning.
Oh, awesome. Appreciate that. And appreciate your sponsorship here of the Element Wealth Studios.
We are excited about the sponsorship.
It's awesome. Appreciate it. All right, so we're having a green day here in the markets, and there's really not any news that's driving that.
No, I think what we're seeing today is just a little bit of a relief rally. I mean, you've had 2 weeks of pretty much down every day. Certain stocks and parts of the market are getting pretty reasonably valued. Don't know that everything's quite bottomed out, but I think what you're seeing is people dipping their toe in a little bit. Probably a little early to call a bottom. You haven't had that big flush out. But really today, that's what it's about. Is I think it's Friday. People aren't selling. A couple people are dipping their toes in. You're getting a little bit of a rally, but this is not sustained big volume kind of rally right now.
Yeah, I just don't think there's enough news, enough of a reason for that, right?
No, and really, you're not going to get a really sustained rally until you see the inflation numbers coming down. There's a lot of question marks about what's the Fed going to do, right? How far is the Fed going to have to go? At what point do we see inflation come down? Until you can get there and get a little bit more clarity, I don't see us really hitting a sustained rally and new highs in the markets.
And earlier this week, I believe Tuesday and Wednesday, we had the CPI and the PPI on Wednesday, the Consumer Price Index, the price of goods at the retail level, and then a measurement of that. And then the Producer Price Index, the PPI, the measurement of the input to the production of goods. Both of those disappointed.
Yep.
Came in, and the market reacted negatively to that news, which just really means, hey, we're not really taming this inflation thing like we hoped.
No, not at all. I mean, right now, we anticipate that later in the year you're going to start to see the inflation numbers look a little bit better because it's a year-over-year number, right?
Right.
So when you get to December, you're going to be comparing to that 6+% inflation number. So maybe we're down 4 or 5% year-over-year then. But there's not really anything being done to help out with it right now, and it's a little bit out of control. And the Fed is just wildly behind the curve.
And I guess what's so fascinating is that this time last year we started to see some kick up of inflation. Our government, the Fed, told us this was transitory, was the word they used, meaning this is really not sustained. Going to be sustained, not going to endure, but that hasn't been the case.
No, not at all. And we pointed out in our forecast at the beginning of the year that the Fed clearly believed that it was transitory, because how can you be at 6+% inflation and sitting at zero? Right. So we said they've got a lot of conviction that it is transitory, and we said to a certain degree some of it will be. But it ain't coming back down to their 2% target anytime soon. So some of this is not transitory. Some of it is. But I do think that they're going to have to continue to raise rates, at least through the summer next year probably. You're probably looking at 2.25 or so by the end of this year, and then a few more rate hikes, probably getting to maybe 3.25 by the time you get to July of next year. If we continue on the path that we're on.
And I think the question is, will that truly have an impact on inflation? Will it bring it down? Historically, I believe we look at the Fed funds rate being somewhere around the CPI, maybe even higher than the CPI, in order to really tamp it down and get it to start moderating.
Yeah,
we're still a ways away from that, even at 3 and change.
You've still got an incredibly negative real interest rate, right? So that's just the rate of inflation minus the 10-year Treasury is typically what we look at.
Yeah.
But what I will say is that the bond market is telling us a little bit of a different story, right? So you see the 3-year to 30-year Treasury market, that curve is really flat. And so what that is kind of indicating to us is that the bond market believes that some of this inflation is going to come down as we get later into the year. I still think we probably end the year with the 10-year a little bit higher, but the majority of the damage in the bond markets is done.
Yeah. All right. So explain for the benefit of our audience, if you will, Jeremy, what that really means when you've got an investment in a bond that has a longer term maturity and the interest rates you get and the return you get on that versus a shorter term, how investors view that.
Yeah. So the longer the term of the bond, the more the price is going to fluctuate up or down with interest rate move changes, right? So we all know that when interest rates go up, bond prices go down. The longer the duration of the bond, the more the price is going to move, right?
Yeah.
Because you've got that much longer until that bond matures.
Yeah.
And so what you're seeing today, and I think what's shocking for investors is, hey, we all know the stock market's correcting, but I'm retired. I'm in a balanced portfolio. And so, as of yesterday, you got the S&P 500 down 20 and the Barclays, or the Bloomberg Aggregate Bond Index down 9. Well, there's nothing in your portfolio that's helping you. So you're looking at this portfolio going like, whoa, what's going on?
Yeah.
I will say this, though. For people who own bonds, this is good. As painful as this is on the short end, if you think about everything in your portfolio that's maturing, well, now you're reinvesting at higher interest rates. So would you rather take a little bit of a hit today and make 2 times as much income or more going forward, or, kind of stay in this, 1.5% to 2%, interest rate range?
Yeah, because interest rate bearing securities, we're seeing interest rates go up. I mean, to the point where you look at a muni bond, a municipal bond, which is not taxable for federal purposes. You get maybe a 3% face value on that, but by the time you factor in taxes, you're looking at a 4.5% return on that, and that's going to go higher.
Yeah, and it's going to continue. And so I think for bond investors, it was really obvious that rates were going to go up, right? I mean, it was inevitable. It had to happen. And so you wanted to be positioned a little bit more short term. Now that rates are higher, you can begin to extend the duration on your bond portfolios a little bit.
Yeah.
And, when you go inside different bond funds and things that you can invest in, when you start looking at the yield to worst on some of these, I mean, pretty high quality stuff. I mean, one of the ones we were looking at the other day was at 6%.
Wow. Hadn't seen that in a while.
No. And so, I mean, if you're talking about yield to worst on a good diversified portfolio, not all treasuries, obviously, to have that kind of yield, you're talking about your future returns looking a lot better. So as painful as this is, it's actually good. It's healthy that we're going through this.
Yeah. I think better days are on the other side. Once you take this medicine, you get healthier.
You got to. I mean, we're literally talking about 12 years of unprecedented monetary stimulus from the Fed.
Yeah.
There is no way to unwind this in a smooth manner.
Yeah.
It just can't happen, right?
Yeah.
And so it's going to be bumpy.
Okay. So I think it's fair to say that most Americans, their primary investment is in a retirement plan, their 401k plan.
Yep.
I don't remember the data, but it's substantial, significant.
Oh,
yeah. And they look at those statements and they start crying, honestly, over the last couple of months with the precipitous decline in value. What do you tell them?
Well, number one, this is, historically speaking, still pretty normal. I mean, this is not a 2008. This isn't a 2020, So when you're investing for the long term for retirement, there are going to be moments like this that are going to happen. So first and foremost, remember that this retirement account is a long-term investment vehicle.
Right.
And at the end of the day, if you're continuing to put in, then you're buying stuff at cheaper prices. And so when things recover, the money you're putting in today will be up. You just got to be disciplined. You got to stick with it.
Yeah. We got a break right here. If you could hang around, I got a couple more questions for you.
Absolutely.
I want you to explain to our audience when we return what the VIX is and what that means.
Sounds good.
Right? We'll step aside right here in middays. We've got Jeremy Nelson, a partner at Element Wealth, and we're in the Element Wealth studios. We'll be right back. Yeah.
I saw CCR play at the Endymion Ball one year. They were great.
Oh, really?
Yeah.
Yeah, Endymion down New Orleans.
In New Orleans,
for Mardi Gras.
Yeah.
I'd be darned.
Yeah.
How about that? Very cool. Jeremy Nelson, partner at Element Wealth, in the Element Wealth studio. So questions on the C-Spire text line, Jeremy, about I-bonds. Explain what that is and whether or not you think those are a good investment.
Yeah, look, so, I mean, obviously we see the headline number on what I-bonds are paying. And, I mean, when you're talking about a government-guaranteed investment, it's a great opportunity right now. Those rates will change, right? They won't stay here. The number one thing to remember is that you can only put $10,000 per person per year in them. So you can't load the boat and get 10% from the government on all your money. You have to hold them at least a year, and then if you hold them for less than 5 years, you have to give back a quarter's worth of interest.
Okay.
So, but yeah, absolutely. As a savings vehicle or for college planning, actually, the interest can be tax-free if you use it for college, things like that. So I just recommend people go to treasurydirect.gov, and you can get all the information on the I-bonds.
And what differentiates I-bonds is that they are indexed to the rate of inflation.
Exactly, yeah.
So, and that's why they're paying a fairly high rate of interest right now.
Yeah, I didn't know if you heard there's some inflation.
Yeah, I heard about that. I see it on the signs in front of the gas stations around the roads. Let's see. And, something else that comes up, and Dave on the C-Spire text line writes in, I understand about being patient with respect to 401k plans, but what about those of us who are close to retirement is a concern, right? So,
absolutely. So if you are close to retirement, the number one thing that you've got to do is a little bit of an analysis on when you're going to need money, how much you're going to need. The one thing I like to explain to people about retirement investing is just because you're retired, it doesn't mean it's the end. Right. It's just the end of the accumulation phase and the beginning of the spending phase.
Yeah.
So money still has a longer-term time horizon. However, because you're not putting money in, you don't want as much risk in your portfolio. So I think that it's important at this moment in time to look and go, hey, what do I own? Because there are still things that are very expensive. There are still, assets that are going to perform very poorly going forward. So you just want to make sure that, hey, what I own is high quality, cash flow producing, good investments. That over time will work. Yeah.
And that you mentioned it in the last segment is that why it's a downside and for equities, and we don't like seeing the losses on those equities. The flip side of that is on fixed income securities, we're seeing returns we just haven't seen before. So, or in a long time, I should say.
So I went back and I couldn't find a drawdown in the Bloomberg Aggregate Bond Index that was this big in my data.
Wow, okay.
So as I was explaining to a client the other day, I said, we are in 08 for bonds. This move that has happened is that dramatic. Now, the good thing is the 08 in a decline in bonds, like high-quality stuff, we're at 10%. That's a lot better than 50% in equities, obviously, in a 2008 environment.
Yeah. All right. I teased that we would talk about the VIX, V-I-X, and I'm not sure that a lot of folks really understand what that is and what that is a measurement of and how that can be an indicator for the markets.
Yeah, so the VIX is the fear index, right? What you're looking at is put-call ratios, and when the market starts correcting hard, right, the fear index goes up. And when the market gets down low, the fear index goes low.
Yeah.
Now, there are vehicles out there that you can trade this stuff on. I don't recommend it. They are wealth destroyers over time. So now if you're trading and you know what you're doing, yes, there's an opportunity to make money. But if you don't understand what you own, over time, these things are wealth destroyers. You really don't want to be involved in them. And it's because of the way that they're structured with futures contracts and things. that have to roll over time, and they will wipe your money out.
And that's really, just to kind of boil it down, what this is trying to do is look out into the future somewhat and analyze investor investment in puts and calls, options to sell, options to buy, and it looks at the ratios between that to try to see, well, do they think the market's going up, it's going down, and if there's a big spread between those puts and calls, that just means volatility.
Exactly, right. And so the way that I follow the VIX, because it is something that I look at on a daily basis,
Sure.
when the VIX spikes extremely high, like in March of 2020, right, during the COVID correction, that will start to signal the bottom of the market. When you see extreme levels, that means everybody's panicking, washing out. That's when it's time to just kind of suck it up and buy, because that's when the market is now really, really cheap. Because you got to remember, a market bottom is the point of maximum pessimism. Right?
Okay.
There's no more sellers. Everybody's sold out. Well, if there's no more sellers, then prices have to go up.
Got to buy.
Conversely, when you see the VIX rolling at extremely low levels for a very long period of time, it indicates complacency. And when there's too much complacency in the market, like we had last year, market gets overvalued, and then we go through what we're going through right now.
Makes sense. Makes total sense. All right. Got to talk about crypto for a minute. Speaking of wealth destruction, good grief.
Wow, yeah. So the reality with cryptocurrency is nobody knows where this thing is going.
Yeah.
Right? And there are some well-founded ideas that are out there.
Yep.
There are some joke coins that are out there. What I would say is there's a lot of gambling going on in the crypto markets. We saw these stable coins that just bust and essentially went to nothing. So it is a very, very, very high-risk investment.
Yeah.
It is not something that we consult or advocate people to do. Our number one advice is if you've got money that you're willing to lose but want a moonshot opportunity that maybe it'll work out, crypto is an asset that can do that.
Yeah.
You and I spoke about this a couple years ago at our event, and I do believe that the blockchain, which is the chassis that
the underlying technology powers the whole thing.
That's powering cryptos, is very intriguing. I think there's a big future in it, but the coins on top of them, it's really tough to say where they're going to go. There's new ones being created every day. To decipher which ones are good, which ones are bad, there's just not enough information out there.
Extremely volatile, going to continue to try to find some sort of equilibrium for a while, I think.
It literally is just a game of supply and demand, right? And so it's almost that game of musical chairs. And, what we see with Bitcoin, the premise behind Bitcoin, limited supply, so in an inflationary period, Bitcoin should be good.
Yeah.
Well, Bitcoin's down 50%.
Yeah. It's not a hedge.
So it's not. It's an ultra kind of high beta tech play.
Yeah.
Which I just wouldn't bank my retirement on.
Right.
If I'm building a financial plan for someone, I'm not banking on crypto being the thing that's going to drive it.
And now we got the federal government in the wake of what's happened, especially with the stable coin, and the Coinbase CEO coming out saying, hey, we may not be able to cover.
Yeah.
If we go bankrupt, your assets could be lost in full here.
Yeah, this is such a new and immature market.
Yeah.
And there's some serious systemic risk, which we're seeing right now.
Yeah. And, even with the craziness of inflation and the money printing, the dollar's still quite strong.
Yeah, now I will tell you, our longer-term forecast is that that's going to turn.
Okay.
Yeah, so we do believe international diversification actually makes a lot of sense.
Sure.
When you look at U.S. stocks, S&P trading around 20 times earnings, you go into the EFA and emerging markets, 16, 14 times earnings. We see the dollar turning here at some point. Think about the government deficits that are coming with these higher interest costs.
Very
down
true.
the road.
Yeah.
And that's going to be a big impact.
All right. And we're having a short-term spike in revenues to the government right now that's probably not sustainable.
Well, and then I was listening earlier, and the one thing I want to say is the government doesn't have a revenue problem; they have a spending problem.
No doubt about it. Jeremy, appreciate you coming on, man. Very
Appreciate
insightful.
you guys. Thanks for having me.
Very educational as well. And we'll do it again. Jeremy Nelson, partner at Element Wealth. We're in the Element Wealth studios. We got half an hour left here on Middays. Please stay with us.